Welcome back to the Comstock channel. My name is Brianne Hendrickson. Today I have Joe Camp with us. Welcome.
Thanks. Welcome to a not so good afternoon to the grains here, nor cattle for that matter, selling off pretty sharply into the bell. So not a lot of positivity here to recap, but we'll try to say something about it.
Remember when I teased Monday that we're going live? Well, it's official. Circle December 14th on your calendar and set your alarms for 5 p.m. Central Time. David and Matthew Cruz will be taking over the live event to talk all things carbon pipeline. Your questions will be taking the spotlight, and if you send them in before we go live to report at comstock.com, we will be answering those questions first. The only positive that we're going to start on right now, I guess, is wheat. Like you said, everything else is kind of red, but we'll start with the positive note, wheat, and they're in the green.
Right. Well, at least the first couple of contracts in Chicago, we'll see if that holds within the next 15 minutes or so. This would be, I think, 7 days in a row where Chicago futures have traded higher here. We show a chart for this rebound recently on wheat, and it's really a potential trend changer here. I mean, there's a long way to go. We can see the slide we've been in since this last summer. But at the same time, you look at some of these moving averages. The blue one up top there is the 100-day moving average. It's been more than 100 days since this March Chicago wheat contract has been above that. We can see the widening of those Bollinger Bands like we like to watch to signal a potential breakout here. And it's a positive feature of this market any way you look at it. I mean, this day really started out as a repeat of yesterday. I know you talked to Justin yesterday about the wheat, and that was a real dominant factor early on in today's trade again here. And it's something we're going to continue to watch because it would be rare as of late, but something that's has been possible in the past, that wheat can become a leader for the rest of the ag commodity space here. And it's on a number of items. Justin talked about the export factor, and that's, of course, what's getting top billing here. Another daily export sales announcement for soft red wheat to China announced this morning. And so that's a string of them. We're on pace to see soft red wheat exports surpass hard red wheat exports for the first time in many years. And so it's a notable shift in the market fundamentals all of a sudden for wheat. And we'll wonder if that can continue to be something that ultimately helps save these corn and soybeans from going any lower.
Let's talk about those soybeans. Like you said earlier, it's not pretty. Not pretty at all.
No. We need to show that chart then too, which is a bit of a reversal here recently. In part, that can be the case that there's been an unwinding of spreads where you have some upside relief on wheat and some downside pressure on soybeans. And that would fit with what the speculators and how they've been positioned, where they have held a net long still on soybeans, but they've been for some time now bearish on the wheat. So a bit of shift in that positioning. We'll see if now this play out for soybeans is about over here. We've been, now down more than $1 since these highs that were just short of $14 on November 15th. At this point, we're probing, testing around this $13 mark. It was a real positive sign, even with a down day yesterday, that January soybeans were able to close back above $13. And it's something we'll watch here going forward, not just the $13 mark, but you have down here around $12.90, a 50% retracement of that broader move up from the May lows. So we can see that on the chart, those sub or mid $11 soybean futures from late May all the way up to just about $14.50, and then now back around $13 to kind of technically split that range and potentially find some support here. The beans, again, partly it's technical that these things snowball lower, that you have spreads unwinding, that you have these speculators wanting to rush for the exit and take what profit they can before they're the last ones out. But you've also got the fundamental influence that triggers that, and that starts with Brazilian weather and this outlook for more rain potentially coming into next week. This is the past 30 days, though, and this is to show a map that tells us, wait, we're not out of the woods yet. Those farmers down there are still very much under stressful conditions. You see that red and yellow, which puts them way short of normal rainfall over this past month. And so, in some sense, the damage is already done. And I bring that up here as we look forward to Friday, this next crop report, where the USDA will potentially adjust these Brazilian production estimates quite a bit lower. Just by what degree will be the question on this next crop report coming up. But as of late, at least a negative, because it was a change in the storyline from what had been so bullish. A little bit of rain in those driest areas of the center west and the northern states of Brazil has been enough of a negative to spook some of those speculators into being less bullish on the soybeans. But the other issue that we're having occur again today, and something that's been a weight as of late on the market, is that crude oil futures are falling, and now down about $3 a barrel today. We had the weekly stocks report out, which was, well, friendly relative to expectations. Crude stocks drew down by more than anticipated. But I think overall, the focus is on where they are at relative to one a year ago and where they're at relative to a normal range. And we show that in the chart up here, where you have crude stocks currently in blue, the 5-year range shaded there in gray. We can see we're approaching the middle of the range. We can see that on the right end here, we're above where we were a year ago by about 7% here on domestic inventories. And in part, that's on the back of what we've also seen reported lately, in that domestic U.S. crude production has been reaching record highs. So, it can be a good thing. We want to be self-sufficient on oil production. We're ramping back up shale activity. But overall, it's a source of pressure on the market at the moment that links back to what we're seeing in the soy complex, where you have soybean oil futures off their highs and a little bit less bullishness on that biodiesel processing sector type demand, which is like the Brazilian storyline, just a change of pace of what had been so bullish leading up to that recent nearly $14 high for these nearby futures. So crude oil down almost $3 at several points today is another negative, unfortunately.
Let's talk about livestock. They are also not having a good time.
Right.
I think before we got on, cattle were not pretty at all.
No, they dove lower. There was a rebound attempt early on. It's been a prolonged slide here for cattle futures. And it's something I link back to the crude oil market, actually. And just in terms of, one of the weaker points is not just extra crude supply, but concern over domestic consumer demand. And we know anytime we bring up consumer demand, that's something that the livestock market is very sensitive to, and cattle have been as of late, where there's some still growing worry about the economy. And that is something that has caused these speculators to want to get out of their bullish positions, like soybeans, where they had been net long again over the recent several weeks. They have for a long time been bullish on the cattle market. That's in part what helped bring these contracts to record highs. But you create a downward spiral when those speculators want to take profit and exit those positions. It ultimately turns the charts lower, and then the trend becomes a sort of self-fulfilling prophecy, because the computers jump on this bearish chart look in a way that snowballs the price lower, and we've observed that. What we want to see, though, is that the fundamentals are going to return, hopefully. I mean, and that's just simply for the fact, in part, that we want the futures to be tied to the fundamentals instead of necessarily just pushed back and forth around with high volatility because of speculative influences. But I think we can get to this point where we've said, all right, the cattle futures break has been overdone and it's overshot to the downside relative to where we see the cash market trading. I mean, if we look at December live cattle futures below 164, that's $10 below where the last benchmark was for cash prices. The discount even sharper for feeder cattle, some 15 to $20 below the real-time index, is a huge break here and a discount to where we think the fundamentals should hold up this market. So we'll see how tomorrow goes. If we have any reversal, you get to a point, I think, where those speculators look around and they say, who's going to sell this now? And there's not quite as much a willingness. And that is something similar to what we're watching for back on the soybeans, which have been, the bigger source of weight here all of a sudden on corn too, where you get below $13 and you wonder about the follow through. If it dries up like it showed signs of yesterday, then we're going to be more cautiously optimistic about still potentially seeing some higher prices into the end of the year and next year. Because if we go back to the seasonal tendencies, we can talk about corn and soybeans, or we can talk about cattle and even hogs, where there is some seasonal upside normally expected into the back half of December and into the new calendar year. So that's what we'll have to hang our hat on, for now, after a pretty rough day all around, grains and livestock.
All right, that'll do it for this episode. Thanks so much.
Yeah, thanks. We'll see you next week.